Let's jump right into this explainer and look at a total financial paradox that just played out with Advance Auto Parts. We're looking at a situation that completely defies conventional market wisdom, and we need to unpack exactly what went wrong here. Because as you know, to really understand how markets think, you've got to look way beyond the headline numbers. So ask yourself this. What usually happens when a company beats Wall Street's earnings forecast by more than 25%? Normally, you'd expect that stock to absolutely soar, right? I mean, when a company smashes expectations by roughly 27%, investors pop the champagne, analysts upgrade their targets, and the market rewards them. That's investing 101. Well, not this time. Here's the setup. Advanced Auto Parts reported an adjusted earnings per share of $1.03. To put that into perspective, Wall Street was only expecting 81 cents. That's a massive difference of 22 cents a share, which gives us that roughly 27% earnings beat we were just talking about. By literally any traditional metric, this is a huge win for the bottom line. But instead of a celebration, the stock got completely crushed. It dropped an astonishing 24.6% in a single trading session. It literally lost nearly a quarter of its entire value in just a matter of hours. And this is exactly what makes this story so fascinating to me. A company that seemingly knocked it out of the park suddenly became one of the market's biggest losers. So, what did investors see that the headline earnings number glossed over? Because, well, this wasn't just some random earnings disaster. They uncovered something a lot more complicated. It was a profit beat colliding head-on with a glaring sales problem. And as we'll see, that collision is probably the biggest clue we have about whether Advance Auto Parts turnaround is actually working. Okay, Section 1, the missing sales growth. Looking at the second quarter of 2026, the company generated $2 billion in revenue. Now, $2 billion obviously sounds like a ton of money, but Wall Street had expected about $2.04 billion. That means revenue missed the mark by around $40 million, or roughly 2%. Investors were hunting for growth, and instead they found a missing $40 million on the top line. But actually, the mess wasn't even the biggest problem. Even more concerning, compared to the exact same quarter last year, revenue actually shrank by approximately 0.5%. This was a giant flashing warning sign. The top line simply wasn't growing. So while the company was somehow becoming more profitable, they were doing it on fewer sales. To really grasp why Wall Street hit the panic button, let's look at a quick comparison. Imagine Company A. They've got a modest profit bump of 5%, but they're growing their revenue by 10%. Now look at Company B, which boasts a massive profit growth of 25%, but their sales are shrinking by 1%. Which one looks more exciting to you? 9 times out of 10 investors prefer Company A. Why? Because earnings per share can go up for a whole bunch of reasons. Maybe costs fall, maybe share counts change. But eventually, you can't just cut your way to growth. You actually need customers to buy more stuff. Moving on to Section 2, inside the turnaround plan. To figure out this turnaround, we have to look at who's actually buying the parts. Advance basically serves 2 main groups. On one side, you have the professional customers, your mechanics and repair shops. Now, this side actually held up pretty well because, let's face it, cars age, they break down, and mechanics always need parts. But on the flip side, the do-it-yourself, or DIY demand, was surprisingly weak. And this matters deeply. These are ordinary people walking into stores to fix their own cars. When DIY sales drop more than expected, it's a huge signal that the everyday household consumer is under intense financial pressure. Now, despite that consumer pressure, the turnaround is actually having some success. Real quick, just as a terminology refresher, remember that a basis point is just 1/100th of a percentage point. Keep that in your back pocket for this next number. Because the turnaround is working remarkably well on the profitability side. In a second quarter, they expanded their adjusted operating income margin by 250 basis points year over year. That is a 2.5 percentage point leap, which is significant. It essentially means they are extracting way more operating profit from the sales they do have. Internally, they are genuinely getting healthier. And they aren't just relying on margin magic here. They're out there physically fixing their supply chain with a new distribution strategy. They're consolidating distribution centers and expanding market hubs. The goal is beautifully simple. Get the right part to the right store faster. In the auto parts game, availability is quite literally everything. If you walk in with a busted alternator and they don't have it on the shelf right then, you're not going to wait around. You'll just drive down the street to a competitor. So this inventory positioning is an absolute game changer for their turnaround. All right, Section 3, the bull versus bear case. Management's updated 2026 guidance really tells the whole story here. Check out how they actually raised their profit guidance at both ends, bumping adjusted EPS up to a range of $2.60 to $3.30. But look right below that. They kept their massive $8.5 billion sales outlook completely flat. They're expecting a measly 1 to 2% in comparable store growth. This right here is the exact blueprint of their turnaround right now, delivering better profitability but without much sales growth at all. So let's look at the optimistic side first. The bull case leans super heavily on the sheer scale of the operation. Advance Auto Parts is no startup. They've got a massive footprint of over 4,300 stores. The bulls argue that with this enormous scale, the investments in distribution, and that resilient professional demand we talked about, they don't actually need explosive sales growth right now. If sales can just stabilize across those thousands of stores while holding onto those higher margins, their future earnings power is going to look incredibly attractive. On the flip side, the bear case is way more cautious, pointing straight at the underlying consumer. The bears are worried that ordinary people just aren't spending on DIY repairs right now. They look at the stagnant revenue base, those weak comparable sales, and they conclude that, hey, you cannot cut your way to prosperity. The danger here is that if stores become less competitive while trying to slash costs, customers walk away, revenue drops, and eventually all those margin improvements just can't make up for a lack of genuine growth. Which brings us to Section 4, the final verdict. The ultimate golden rule to extract from this explainer is this. Stock markets do not reward companies simply for beating expectations. They reward companies when investors believe future results will be better than expected. Advance Parts didn't lose a quarter of its value because the business completely failed. It crashed because the market demands proof of future top-line growth, not just current cost-cutting. A company that beat EPS estimates by 27% got punished because investors collectively repriced its future earnings power. They needed hard evidence that the actual business of selling auto parts was growing. Ultimately, this wild 24.6% stock collapse is a real-time test of a classic turnaround story. Yes, they are extracting more profit from every dollar they make, which is awesome, but they're making fewer dollars. So we're left with one massive question for the future. Can they turn these vastly better margins into real sustained sales growth? Because if they can, this stock collapse is going to look like a crazy overreaction. But if they can't, it was a very harsh, very real warning sign. Definitely something to think about the next time you see a company absolutely smash their earnings target